Welcome to the second half of the conversation with Scott Kelly, CEO of Black Dog Venture Partners. You said earlier about the goal being to get the next meeting is really important, because in a short period of time, whether it's 1 minute, 3 minutes, 5 minutes, even an hour, you're never going to be able to get the whole story out there. And so being able to just hook the investor and get them excited about learning more is the key. And to your point, I think telling a story is mission critical to do that.
Mhm.
So so in addition to all the things that people should do in pitching, are there things they should not do?
I think some of the phrases that we probably both dislike to hear is if I get 1% of the market. Don't use those phrases. Just don't do it. The reality is you're probably never gonna get 1% of the market. And we just want you to generate enough revenue to provide an adequate ROI upon exit. Okay. So don't use those kind of phrases. Don't say that you're going to be a unicorn. Never ever say you don't have competition. You have competition. Okay. The pencil is competition to this computer. And I think you really have to have a true understanding of what competition is. So those are some of the critical things that you should definitely say in your pitch.
Yeah, I agree with all those. So in terms of putting on our hats as investors, so say that we're sitting at the VC fast pitch competition.
Mhm.
What do you think investors should be looking for? Like, what signals should they be looking for with such short pitches?
Well, again, I think the things they need to realize when they see a pitch, they want to know someone has practiced the pitch and knows it internally. They really need to be able to talk freely about it. We have entrepreneurs that we tell them to use 7 or 8 slides. I can tell you some of the best pitches where people talk for 5 minutes with no slides. They were able to engage and inspire with just their ability to talk about the business. So that would be, that's the thing that I look for and other investors look for. We talked about this a couple of times already. Know your numbers. Really know your numbers. Know your SOM, TAM, all those things. Know your LTV. Know your profit margins. Know those things, because those are things that determine, profitability, and profitability determines, success and an ultimate exit. And at the end, I think you need to be personable. I think sometimes I have found a lot of entrepreneurs, I would like them to be confident, but not arrogant. Because again, we're still dealing with people and human beings and personalities. You do not, you can have a great pitch, but if you piss off an investor, next, don't be a jerk.
I think that's a great one. And I think of it as just be easy to deal with in all regards. You don't need to be the funniest person or the most, likable. You don't have to be the most charismatic, but you just have to be easy to work with and just make
Right.
things easy. I mean, I just run into that all the time, where there's folks that I think are smart and they've got good ideas and maybe they've even got good execution capabilities. But then to try to partner with them becomes such a labor that it's
Mhm.
not worth it. And to your point earlier, there's so many possibilities, so many opportunities out there for both startups and investors, that if that fit isn't there and there's too much friction in the relationship, there's no point of going on with it, unless it's like the world's like best idea that nobody else is doing, and that's not going to be the case, right? And so I really think that's really key. I wrote an article recently, relatively recently, for Built In, which is a website that caters to tech founders, and it was really about how to pick the right investors to
Mhm.
partner with. But it kind of works both ways. Like, one of the things that founders should look for in an investor is investors that are easy to work with. If they're
Absolutely.
going to like call you all the time and ask you stupid questions, and they don't know your business and they don't know your model, and they don't know that they're not used to working with the stage that you're at, like that's
Mhm.
going to be painful. And it works in both directions.
Right.
Right. And so I think just establishing that rapport and trust and just ease of working with somebody is so important. And this goes back to what I was saying earlier about milestone-based financing and not really knowing until you get into the negotiations
Mhm.
and not knowing everything until you've given them money. If they're like a pain in the neck to deal with before they have your money, like they're going to be even
Right,
harder to deal with once they have it, you know?
exactly.
And, you know, I agree with you too about the idea of like arrogance versus confidence. I think having a lot of confidence is really important, but there's also really no room for arrogance because there's always competition. You know, there's always people that we could deal with that aren't arrogant, right? Uh, you know, and so just being, you know, friendly is friendly, affable, fair, I think is really important.
Mhm.
Actually, I always go back to this acronym called FAT, FAT, easy to remember, fair, aligned, and transparent. That's
Mhm.
what I want out of every relationship. And if you're not all three of those things, you're certainly not going to be, you know, somebody I want to deal with.
Right,
And, you know, and that also builds trust because once, if you're fair and you're aligned in your expectations and your goals and you're transparent about how you're doing things, both good and bad, then, you know, that will ultimately build trust. And then that can really help to scale a relationship.
yep, absolutely.
And I guess one of the underlying themes I've been thinking about a lot is that early stage investing really is not about numbers. Like all the numbers are kind of funny, you know, funny numbers, right? Like
Right.
you make them up, you know, and obviously they should be based on some reasonable assumptions, hopefully. But the
Mhm.
reality is the numbers don't really mean anything. It's really all about the relationships and the
Agreed.
quality of the people. And I think that's what makes early stage investing so difficult, right? Because
Absolutely.
it doesn't matter how good you are as a financial analyst. You'd be better served just being a good, you know, psychologist in a sense, right? You know what I mean? Like being able to analyze the person as opposed to the balance sheet or the income
Right.
statement, you know? So I want to talk about some kind of big picture thematic items. Like, I'm really
Okay.
curious what you think about this. So with the global, you know, startup ecosystem continuing to grow as innovation, you know, really grows faster than ever, adds more value than ever, I think we're going to see a change in the structure of how companies are funded, you know, how investors are matched with founders. And you know, you're on the forefront of this because you've been doing a lot in you know, with different organizations that you run or have leadership roles in. Where do you see early stage investing headed structurally in terms of the fundraising process, the company scaling process, just anything that's structural that you see changing?
Well, I think it's already begun to happen quite a bit. And, crowdfunding has become something that nobody paid attention to, becoming, I think, a very good form of raising capital. Because the reality is that if you have a company that has a lot of customers, a lot of fans, why not get them engaged as an investor? And I think that's a trend that's going to continue to grow, and it's grown exponentially. I remember, God, I think it was 2007 when the Jobs Act was passed. I think I was at a pitch event in Las Vegas, and you know, um, everyone didn't think it was the way to go. And now you're finding funds are raising money through the crowd. And I think that is probably one of the a trend that's continued to escalate and becoming, even more significant. And obviously, I think obviously with some of the changes in legislation very recently in the crypto space, I think tokenization of assets and using decentralization to raise capital and those things are becoming they had their shortfall, and now I think their second act is beginning again.
I think that's a great point. And you know, this idea of crowd fundraising kind of brings up another thought around marketing and the ability to market digitally, you know, via social media mainly.
Mhm.
And you know, that's something that wasn't there before. You know, a decade ago, 15 years ago, it wasn't there almost at all.
Mhm.
And it's been just expanding exponentially. So now you've got folks that are able to create a brand and create value from that brand, you know,
Mhm.
very quickly in some cases and scale it with almost zero marginal cost,
Yep.
right? And so one of the things I've been thinking too is when I evaluate early stage companies, I'm actually looking a lot less at the technology now because I think that's actually become more commoditized. Like if
Mhm.
you think about like programming, yep, that's going to get replaced largely by AI, because that's
Mhm.
something that a machine can do better than a human, because programming is just translation, right? It's literally
Right.
just translation. And so that's going to go away. And therefore, you know, the founders that used to become, you know, the unicorn builders that were programmers mainly, right, or had a tech background, to me that's actually not that valuable. To me that's like pretty much commoditized now. Like almost anybody can do it. Machines can do it more cheaply. 5 years from now, I don't even think programmers are going to have much usefulness at all.
Mhm.
I know that, you know, that maybe some people will push back on that. We'll see in 5 years if I'm right or wrong.
Yeah.
But I can say this: if you can market really effectively, I've seen people that have become, you know, 100 millionaires that don't even have a product that I think is useful in any way. The product is them, right?
Yep.
And so that's what I'm looking for more than ever now is, can this person market effectively? Because if you can do that, it's so cheap to do.
Right.
So if you know, so I'm curious what you
And,
think
and,
about
and the
that.
other thing you do, when you do, obviously you have equity-based crowdfunding, but you have reward-based crowdfunding like Kickstarter and Indiegogo. If you think about this, if I'm an investor and someone was able to raise hundreds of thousands to millions of dollars pre-selling their product, they've demonstrated product market fit while they raise capital in an efficient means.
Yep.
And that goes a long way to encouraging me to make a commitment to them and other investors. So I think, crowdfunding has a dual purpose. I think it's one, probably three purposes. One, it's obviously a cost efficient, non-dilutive way to raise capital, or reduced dilutive way to raise capital in some cases. It helps provide product market fit, or helps you determine how to adjust your product market fit and your go to market. It creates great PR opportunities, great exposure opportunities. And I think, I think anybody who has a product to sell should at least consider that if they have an audience to sell it to.
Great points. You know, related to the fundraising aspect, another theme that I think will be relevant is more diversification in the funding universe. You
Mm-hmm.
know, historically it was VCs that were doing almost, you know, all of the investing in earlier
Right.
stage startups. I mean, obviously the friends and family and the angel, which is oftentimes just high net worth individuals. But if you think about like Series A through Series D companies, that was almost all VC. Now I think you're seeing a lot more family offices. I think you're
Mm-hmm.
seeing a lot more institutions that have built their own
Yep.
venture arms, or that maybe don't even have a venture arm, but they can still do direct investments in certain deals that they like if it's strategically
Mm-hmm.
aligned. And so one of the things, you know, I've been, you know, thinking a lot about is how that's going to change the industry, because we're going to have, you know, a lot more dollars coming from different places, which also means that the model of pitching will differ
Mm-hmm.
as well. It won't just be, hey, if I want to build a startup, I've got to, you know, go out to Silicon Valley, you know,
Right.
meet some people from Stanford, go out to Sand Hill Road, right? Like that model still works, of course, but I think that's changing, because now you can raise capital, you know, via, you know, crowd fundraising. You can raise money digitally pretty
Mm-hmm.
easily, you know, on a Zoom. You can, you know, access global investors much more easily. And
Right.
these are all themes that have been building for years, but I think we're starting to get to the point where it's like really changing rapidly now.
I agree. And, it's interesting you say that, because I have found, the reality is, frankness, when I do these VC fast pitch events, the well-known investors draw the crowd.
Hmm.
It's the pickup truck millionaires and billionaires that make the investments. They're not beholden to limited partners. They make their investments. One of my favorite books when I was young was called The Millionaire Next Door. And it really talked about, the pseudo affluent versus the truly affluent. And I think for startup investors, startup entrepreneurs, you know, don't judge a book by its cover. It doesn't have to go to Stanford to be rich, with respect to Stanford. And so I think you're right. There's going to be a lot of different ways, a lot of different resources. I think there's a lot of different ways of structure. There's royalty-based financing. There's all debt, venture debt. I think entrepreneurs have to explore other ways as to go to the traditional, venture capital or even angel investment, because there are, you're right, like you said, a plethora of different ways and a plethora of different entrants into the market.
And, I want to talk a little bit about venture debt just to help educate, folks that might not know how it works. So yeah, let's talk a little bit about what that is. And it's not for early stage companies typically. It's
Mhm.
usually for companies that have revenue. But in your view, knowing thousands of founders, how could venture debt be, helpful to them?
Well, I think at the end of the day, your goal is to maintain the integrity of your cap table and maintain the integrity of your ownership in that cap table. And so I think so for one, from that standpoint, it's extremely valuable as you get later stage. Secondly, it provides a level of flexibility that you may not have with venture capitalists. You may not have the same onerous covenants or other aspects to it. It is going to be somewhat more based, on the value of the revenue stream or the value of the balance sheet versus some other esoteric, scenario to some extent. But I think it provides a real opportunity to build a business, and in all frankness, and probably even in this market, the cost of capital is going to be significantly less than going after equity. I think the reality is, don't be afraid of a coupon.
I think that's a great way to put it. It's a nice complement to equity financing. There's a lot of misconceptions about venture debt, and sometimes companies that haven't been able to raise equity at in the size or the price that they want will then seek out venture debt, but it's actually not an option for those types of companies. It's
Mhm.
not rescue financing, in other words. It's really financing for the companies that are doing really well and therefore have earned the ability to access this type of capital, right? And it is a lot cheaper than equity capital. The average interest rate on venture loans is mid-teens.
Mhm.
So it's not cheap, and but these are also this is not the U.S. Treasury. Right.
Right.
Like these are early stage companies that are oftentimes not profitable or barely profitable. So mid-teens is actually quite fair,
Sure.
and then the venture lenders will also take a little bit of equity upside.
Mhm.
And that's actually a really good thing because it aligns interests over the long
Mhm.
term. So remember, I was talking earlier about this acronym FAT, fair, aligned, transparent. Well, if the lender didn't have any equity in the business, then all they care about is getting their money back on the loan, and they wouldn't care about the long-term success of the business. So the idea that the loans are paired with some equity participation is actually in the best interest of the founders, because now
Sure.
they know that the lender is not there just to give them money for the short term. They're really there to fund their longer term growth and have a vested interest in their long-term success.
Mhm.
So that's one of the things that I think a lot of people don't really understand, is that lenders are long-term investors too.
Right.
The loans might only be 3 or 4 years typically, but the equity participation is can be in perpetuity essentially, right?
Sure.
The other thing I wanted to add around just the idea of like optimizing a cap table is I think it's important to have a diverse cap table.
Mhm.
One of the things I've been hearing a lot of recently from founders is that they're really disappointed in a lot of their VC investors, because
Mhm.
the VCs push them to raise a lot of money and then spend a lot of money to get that top line growth to be growing 50, 100% every year, but they weren't actually profitable. And
Mhm.
so when the companies then went out to raise money in the last 18 months and weren't able to anymore, or certainly were not able to anywhere close to their previous valuations, they realized quite quickly that, wow, our business might actually die because we're not profitable, and the
Mhm.
only way for our business to survive is to raise external capital, which we now can't access. And so a lot of founders that I've been talking to are pretty disenchanted in a sense. And look, they've got to take accountability, right? They made the decision to take the capital, so they can't blame it on the VCs that gave them the money. But the reality is, I think there's a big shift happening now where founders are much more inclined to bootstrap longer,
Mhm.
to have a diverse capital table, diverse set of investors. Some might be strategic, Some might, some might be much longer term focused, like a family office. Some might be lenders that, that are providing them debt capital, and some might be, traditional VCs. But having that diverse base, I think, helps de-risk them, and it also gives them more perspective because they're getting input not just from VCs that are hyper focused on growth, but they're getting input from a lender who might say, you know what, I'm okay with you growing slower if you do it in a way that reduces risk and that is more sustainable, right? So that's one of the things I've been, advising a lot of founders to think about is how to diversify their cap table and get the right types of investors in early.
Well, and I think that's even before venture, even for early stage dealing with angels, I think it's paramount. But when I tell entrepreneurs, we're out there seeking investors, we obviously there's three qualifications. One, the ability, interest, and knowledge in the space, and their strategic fit. You don't want dumb money. You don't want people, unfortunately, I found in my past, some of the smaller angel investors are the ones that are, quite frankly, the biggest pain in the butt. So you really have to have that, idea of being strategic about that and building a cap table, properly from a strategic standpoint, looking at, debt as a complement to equity. Because at the end of the day, you want to make sure that you provide something that's mutually beneficial to all concerned in the company.
I wrote an article recently for Built In called Founders, Here's What to Look For in an Investor, basically helping them identify the right types of investors. And the four things that I highlighted as desirable traits were, one was aligned vision and values, right? I think that's really important. And to your point that you brought up, domain expertise, right? And a network, right? Like having a network and domain expertise that's related to what that specific company is doing. Having financial credibility, I think, is big because there's a lot, especially early stage, there's a lot of tire kickers that are not going to write a check, but they're going to ask you a million questions and they're going to use up a bunch of your time. And then ultimately, they're not going to write a check. And a lot of these folks, I think, are actually like identifiable. Especially in my world, I go to a lot of conferences that are institutional investors and large family offices. And there's probably 10% of people there that I see at every conference that have probably never written a check in their life. And they're what I call the fake family offices, right? And everybody knows who they are. And, they're a huge waste of time. So when they want to talk to me, I don't really have, much to talk about with them, right? Like, yeah, I'll have a beer with them and then I'm out. Like, I'm not going to spend any time telling them what I'm doing in my business because they're never going to do anything. And then the other thing I would say that's really important is just experience with similar stage companies, right? Like, man, like running a investment fund like I do, that's a drawdown fund, it's a closed-end drawdown fund. It's very different from a liquid ETF that's publicly traded, right? And I've got investors that love the idea of venture debt, but they don't actually understand the structure of the investment, despite despite being told or having the opportunity to read everything about it. They don't actually do the work, and then then they don't understand why there's like not liquidity because it's a 5-year lockup. I mean, and so I think that happens a lot with founders too, is that they get investors that don't really have experience with that type of company and that stage. And so they, with early stage companies, as like they're going to change their plans, 50 times, and they're, they're going to miss their projections, in perpetuity, right? And they're going to have a lot of mistakes. And instead of getting worried about that or pissed off about it as an investor, you have to realize, hey, this is an opportunity to help this company through hard times with mentoring, with strategic introductions, with strategic capital. And so those are four of the things that I think about. What are some things that you think about that founders should watch out for with investors, like red flags?
Yeah, you need to ask, especially at the early stage, you need to do as much due diligence as them as they do on you. I think you really need to know, what's the source of their capital? Are they truly an accredited investor? Do they have the ability to take a 100% loss? and keep going. I think the reality is, again, because there's a lot of people that make a lot of money that do know nothing about angel or venture investing. So I think it's important to ask those questions. And I tell, I was told many years ago by a former boss, if you ever want to enjoy Thanksgiving and dinner, don't invest family money. And I think there's some real wisdom to that. Now, obviously, in the beginning, you may have to go after family money, but you need to be 10 fingers on the table, fully disclosed, and tell them you're buying a lottery ticket, you're buying a scratcher, and we may hit the jackpot, but the likelihood is we're not. And be okay with that in the beginning. And I think that's really paramount when you're talking early stage. And if the investors don't have experience, they really need to know and understand. You probably need to educate them on the risk factors and the dynamics of investing in early stage, so they can do it. The last thing you want is someone losing money and then wanting it back, and then creating more problems. It's the reality is there's no do-overs, and I think that's really important in your due diligence with especially early stage investors.
It's so tough because when you're a founder, you need capital.
Yep.
And sometimes the only place to get it is the wrong type of investor, and you don't really realize until it's too late. There's never a sign on their forehead that says, I'm going to be a pain in the neck and make your life miserable, right? I wish. We need to figure out a test for that and then stamp them all on the foreheads.
Saying no to money is a very difficult thing for entrepreneurs to do.
Exactly. But to your point, I think doing the diligence up front and being thoughtful around it, and also just developing the relationship before you take the money, right? Again, goes back to that idea of milestone-based financing, right? It's the same concept. It's let them show you and put them in situations where they're not telling you, but they're showing you. Let them reveal themselves. And sometimes that means taking a smaller commitment up front. So they might say, "Oh, I love what you're doing. I want to put in $1 million." Okay, well, maybe you take less than that. And also, I think this is probably the most important thing, that in many respects, when you're going to enter a contract with anybody or take an investment, figure out your exit options before you enter, right? Make sure that you can, if things don't go well, you can exit, and it's not going to be incredibly painful to do so. I mean, it might cost you money, and it'll certainly cost you something, whether it's time or money or energy, but if you can get that exit structured in advance, that makes it so much cleaner. I mean, that's probably my biggest lesson learned as a founder myself, is just every contract I look at, first thing I look at is, how am I going to exit this?
Well, you make a valid point, because I tell everybody, especially, with entrepreneurs, it's getting the money in is the easy part. Getting the money out is the difficult part.
All right, so I've got 2 more questions. So we've got about 5 minutes left.
Okay.
The first is, how should investors think about accessing innovation as an asset class? Like, how can they do so safely and effectively?
Well, I think the reality is as I mentioned before, align yourself with experts in the space. Align yourself with the people that understand the technology from both a practical and short-term and long-term. And secondly, if you're not willing to get educated, like I said, build the people around you that are getting educated in the space. Because obviously, I forget what the ratio is now, but several years ago they said the entire knowledge in the history of the world doubles every 270 days. I'm sure with Moore's law that's probably every 7 days now. So you really have to be open and to knowing what you don't know, and finding a way to get educated or find people that are educated.
Great points. All right, so last question of the day. What themes do you think are most important for investors to be thinking about over the next 3 to 5 years?
Well, obviously AI, I think, is going to be extremely important. Decentralization is extremely important. I think those are things that are now moving forward, and they're moving at breakneck speed. So I think also there's got to be some really understanding of different geographies that have opportunities. Look at India, look at Africa, look at, Central South America, other markets that, are creating some great innovation. And so I think that the three themes, obviously global has always been something important, but I think it's becoming more important because technology is going to make the world smaller. It continues to do that. But obviously, artificial intelligence and machine learning is going to be obviously something that's going to be life-changing. It already is in some respects. It will continue to be so. And then obviously, especially here in the States with the change of legislation, I think the whole, decentralization of finance and the economy is something, is a theme that's not going anywhere.
Great. So for folks that want to get in touch with you and attend VC Fast Pitch, talk about what you're doing at Black Dog Ventures, learn more about TCA Venture Group, what's the best way to do that?
Well, obviously, you can go to blackdogventurepartners.com or vcfastpitch.com, and you can find me on all social media channels at Black Dog CEO.
Excellent. Scott, I really appreciate you coming on. Like a wealth of knowledge, especially when it comes to the early stage space. I feel like we could talk about this all day. And
my pleasure. Thank you for having me.
Yeah, you're welcome, Scott. And thanks again for joining. And thanks everybody for listening to the 7 and 7 show with Zack Ellison. See you next time.